Macroeconomic models always promise this very certain kind of clinical precision, don't
Oh,
they?
absolutely. Yeah.
Like, you adjust an interest rate
Yeah.
or you tweak a fiscal deficit target, and the gears are just supposed to turn in this very predictable, engineered way. The textbook tells you that input directly leads to output.
Right. It's a comforting illusion, really. Our policies cleanly categorized on a spreadsheet, where human behavior perfectly mirrors all those rational actor theories.
But then you step out of the seminar room and into the actual mud of
Yeah.
Indian agriculture, and that precision machine just entirely breaks down.
Completely shatters. Yeah.
So today, we are tearing down that broken machine. Welcome to this custom-tailored deep dive.
Yeah.
If you are tuning in to tackle the IES General Economics Paper 4, specifically GE-04, you already know that the gap between a textbook policy and the muddy reality of a village farm is exactly where the test questions live.
Oh, for sure.
I mean, just look at the recent past year questions. The 2024 paper demanded an analysis of MG and REGA's actual success as an employment backstop. Then the 2025 paper hit you with the labyrinth of minimum support prices and the invisible constraints imposed by the WTO. These aren't just historical footnotes, right? They are the live breathing tensions of the rural economy.
Exactly. And to master this material for your exam, we can't just memorize what the policies are. We really have to trace the whole life cycle of the rural economy,
Right.
starting all the way from the physical dirt and moving right up to the global trade tribunals.
And as we navigate this, from the fragmented soils, through the chemical highs of the Green Revolution, into the friction of the Mandy's, and finally the government safety nets, we are going to apply one unbreakable analytical rule for this deep dive.
And it's a crucial one.
Yeah. We are never just going to list the mechanics of a scheme. We are going to aggressively contrast the pristine economic logic on paper against the messy political economy of what actually happens when it hits the ground.
Because that friction of execution, that's the whole story right there. The theory is flawless until human nature, local power dynamics, and, institutional decay get involved.
So let's start at the very foundation, which is the dirt itself. Before a seed is even selected, we have to look at the physical reality of the agrarian structure. And the baseline data is just staggering.
It really is.
Roughly 86% of Indian farmers are classified as small or marginal, meaning they operate on less than 2 hectares. The national average holding is a tiny 1.08 hectares.
Basically a large backyard in some countries.
Exactly. Now, let me play devil's advocate here, because this goes against day one microeconomics. If I'm looking at a 100-hectare farm with combined harvesters and massive economies of scale, it absolutely must be more efficient than a 1-hectare plot, right?
I think so, yeah.
Like a giant optimized factory will always beat a small artisanal boutique in terms of output per square foot.
It seems like an ironclad law of economics, but the empirical data in Indian agriculture completely shreds it.
Really, completely shreds it.
Oh, yeah. What you are running into is the inverse farm-size productivity relationship, or IFSP.
Okay, IFSP.
Right. For decades, NSO and NABARD surveys have consistently shown that as the size of the farm decreases, the yield per hectare actually increases.
Wait, increases?
Yes. Those tiny 1-hectare plots are pumping out more crop per square meter than the massive estates.
I mean, I understand that's what the data says, but walk me through the mechanics of how that is physically possible. Why doesn't the sheer scale of mechanization on a large farm crush the smallholder's yield?
Well, it all comes down to labor dynamics and risk aversion. Think about a smallholder family on that 1.08 hectares. They rely almost entirely on family labor.
Okay.
When the family works the land, there are absolutely zero supervision costs. Every single member has an existential stake in maximizing the output of every square inch of that soil.
Because if they fail, they don't eat.
Exactly. So they engage in really intense, meticulous practices. They do mixed cropping, they intercrop, they manually weed with a level of care a hired hand would never, bother with.
Right, because their risk tolerance is effectively zero. They plant multiple crops, so if a pest wipes out one, the other one survives.
Precisely. Now, scale up to that 100-hectare farm you mentioned. The owner physically cannot farm that alone. They must introduce hired labor.
And there's the catch.
Yep. The moment you introduce a daily wage worker, you introduce the principal agent problem. The hired worker gets paid the exact same wage whether the yield is 10 quintals or 20 quintals.
So they have no incentive to do the back-breaking, meticulous work.
None at all. So the large landowner has to spend massive amounts of time and money just monitoring the laborers. To minimize those transaction costs, large farms tend to grow single, lower maintenance crops.
Ah, I see.
Yeah, they basically sacrifice maximum possible yield per hectare just to keep labor management manageable.
Okay, so the logic of IFSP clicks into place for me.
Yeah.
Intense family motivation and zero principal agent friction drive up the land's productivity.
Right.
But here is the massive disconnect. If these small farms are so incredibly productive per hectare, why is the Indian smallholder the absolute poster child for chronic economic distress?
That's the tragic part. You really have to separate land productivity from labor productivity.
Okay, explain that.
Yes, the soil is yielding a lot, but because the plot is so microscopic, the absolute volume of the harvest is still tiny. A high yield on 1 hectare is still barely enough to feed a family, let alone generate a marketable surplus to, pull them out of poverty.
Right, because 100% efficiency on a tiny plot is still a tiny amount of food.
Exactly. And more importantly, this structure leaves them completely financially vulnerable. They have zero bargaining power when buying fertilizers or selling their crop, and they are completely shut out of capital markets.
Because you can't justify a bank loan for a tractor on 1 hectare.
You just can't. So they are trapped, highly efficient, but desperately poor.
Which naturally begs the question, why is the land so fragmented in the first place? If we know this structure breeds poverty, why didn't the post-independence state fix it?
And they tried, right? That was the whole point of land reforms.
Yeah, the Zamindari abolition, tenancy laws, land ceiling acts, they absolutely tried.
So what was the logic there? The underlying economic logic was sound. The state recognized that an agrarian economy couldn't modernize if millions of landless peasants were just sharecropping for absentee landlords.
Right.
The intent of the Ceiling Acts was to mathematically cap how much land one person could own, confiscate the surplus, and redistribute it to the landless tillers.
And the economic theory there was pure productivity, right? If you give the tiller ownership, you give them the incentive to invest.
Exactly. Why on earth would a tenant farmer buy a tube well if the landlord can just evict him next season?
But the theory met the ground truth of rural power structures. The implementation of land ceilings was a masterclass in political economy loopholes, wasn't it?
Oh, it was a disaster of evasion. The state legislatures that passed these laws were heavily populated by the very landlords the laws were supposed to target.
Of course.
So they built in massive exemptions for orchards, grazing lands, and trusts. And when that wasn't enough, they used Benami transfers.
Break down the mechanics of a Benami transfer for me, because this comes up a lot. How do you fake a land record on that scale?
Okay, so imagine a landlord facing a ceiling of, say, 15 hectares, but he actually owns 100. He would simply partition the deed.
Okay.
He'd register 15 hectares in his name, 15 in his wife's name, 15 in the name of a distant cousin, and the rest in the names of his trusted servants or even entirely fictional people.
Wait, fictional people? Like made-up names?
Literally made up names. On paper, the state saw 10 different legal smallholders. In reality, the landlord still controlled the entire 100-hectare contiguous block and all its revenues.
Wow.
Yeah. The surplus land that was supposed to be redistributed simply vanished into a paper maze.
And what about the tenancy reforms? If the state couldn't redistribute the land, did they at least protect the people renting it?
Actually, they arguably made it worse by driving it underground.
How so?
Because the new laws gave strict rights to tenants, and in some states, they outright banned leasing. So landlords became terrified that a formal tenant would eventually claim ownership of the land.
Oh, I see. So they just stopped signing written leases.
Precisely. So we enter the era of the oral lease.
An oral lease, like just a handshake.
Just a handshake. Millions of farmers today are oral lessees. They farm the land on a simple verbal agreement, usually handing over like 50% of their crop as rent.
And let's walk down the chain of causality there, because for the exam, that handshake has devastating macroeconomic consequences.
Massive consequences.
Because if you only have a handshake, you have no legal document proving you are a farmer. And if you have no paper, you can't walk into a branch of a formal bank and ask for a subsidized agricultural loan.
Right, because you have no collateral.
Exactly. So where does the oral lessee go to buy seeds for the upcoming season?
They walk right to the door of the village moneylender, who, by the way, might also be their landlord or the local input dealer.
Oh, wow. A total trap.
Yeah, and they borrow at usurious rates, 24, 36, sometimes 48% interest annually.
That is insane.
It is. It's a direct pipeline from a failed land reform policy in the 1960s to the crippling debt traps we see today.
And even today, the attempt to clean up this paper maze like the Digital India Land Records Modernization Program, or DLRMP, is struggling,
Okay,
right?
definitely.
Because the idea is to digitize everything to provide clear, indisputable titles. But when the baseline data is a century of messy, disputed, Benami-ridden paper records.
You're just digitizing the chaos.
Exactly. It freezes the chaos into a database. And because of this failure to reorganize the physical structure of the farms, by the mid-1960s, India was staring down the barrel of mass starvation.
We were living ship to mouth. We were heavily dependent on PL-480 food aid from the United States.
We had a booming population, but we couldn't expand the area of land under cultivation, and we couldn't easily consolidate the fragmented plots.
So if you can't change the size of the farm, you have to fundamentally change the science of the farming.
Which is the perfect pivot to our next section, the Green Revolution. The technological shock here was unprecedented. We brought in high-yielding variety HYV seeds.
Right, specifically the dwarf wheat from Norman Borlaug's research in IR8 rice.
But you pair those seeds with massive, unprecedented doses of chemical fertilizers and synthetic irrigation, and the yields didn't just increase, they exploded.
They did. But here's the critical insight you need for a master's level analysis. The technology alone, existing in a vacuum, would have been a spectacular failure.
Wait, hold on. Let me piece this together.
Go ahead.
If I'm that marginal farmer with 1 hectare, and a government extension worker hands me a miracle HYV seed, I'm actually terrified, right?
Absolutely.
Because this seed requires expensive chemical fertilizers and guaranteed water. If the monsoon fails, or if prices crash at harvest, I don't just lose my crop. I lose the massive debt I took on to buy the chemicals.
Exactly. The risk is astronomical.
So the seed is basically an economic hazard unless someone guarantees I won't go bankrupt using it.
You've nailed the exact vulnerability. The smallholder cannot absorb that level of risk, so the state had to construct a massive institutional scaffolding around the seed to de-risk it.
And what did that scaffolding look like?
Well, they created the minimum support price, the MSP, to guarantee a floor price, so the farmer knew exactly what they would earn before they even sowed the seed.
Okay, that covers the price risk.
Right. Then they established the Food Corporation of India, the FCI, to physically buy the grain so the farmer wouldn't be at the mercy of private traders.
Got it.
And finally, they ramped up institutional credit to finance the inputs. The Green Revolution is the textbook case study of how technological change is utterly useless without institutional change. The biological technology only took root because the economic institutions absorbed the shock of the risk.
That makes total sense. And purely in terms of caloric output, it was a triumph. We went from producing around 72 million tons of food grains to over 330 million tons today.
We achieved food security.
But the bill for that intensive intervention has finally come due. Let's look at the spatial and environmental distortions. The Green Revolution essentially bypassed half the country, didn't it?
It was incredibly concentrated in the Northwest, Punjab, Haryana, and Western UP.
But why there? Why ignore the eastern heartland, places like Bihar, Odisha, Eastern UP? I mean, they actually sit on massive, naturally replenishing groundwater aquifers.
Because the government was in a panic. They needed immediate results to stave off famine. HYV seeds require highly controlled, reliable water.
Right.
Punjab and Haryana already had a legacy of canal irrigation infrastructure left over from the colonial era. The state couldn't wait 10 years to build out the east. They went where the plumbing already existed.
But the long-term consequence of that panic is what we see in Punjab today. The policy incentivized farmers in a semi-arid region to grow water-guzzling crops like paddy, purely because the FCI was aggressively procuring it at MSP.
And the environmental reality today is apocalyptic. Because paddy requires standing water, farmers pump the aquifers dry.
How bad is it?
The groundwater table in Punjab is currently plummeting by half a meter to a full meter every single year.
Every single year. That's terrifying.
Yeah. And at the same time, the aggressive monocropping of wheat and rice has destroyed the soil biomass, meaning farmers have to dump exponentially more urea into the dirt every year just to maintain the exact same yield.
It's an ecological treadmill, and the motor is burning out.
Precisely.
Okay, so we've solved the production problem at massive ecological cost. Punjab has pumped out millions of tons of surplus grain. But growing the crop is only half the battle.
Right, you have to sell it.
If that farmer can't physically move that harvest to a buyer without being exploited, the high yield is economically meaningless. So how does a smallholder actually navigate selling this surplus?
Welcome to the friction of the Mandi. The transition from the farm gate to the consumer's plate is governed by the Agricultural Produce Market Committee system, the APMC Acts.
Now, on paper, the APMC was supposed to be the farmer shield.
Yes, that was the idea.
The underlying logic was that before these regulated markets, a farmer would just sell to the village moneylender to clear their debts, and the moneylender would dictate a predatory price. So the APMC mandated that the first sale of agricultural produce must happen in a regulated government market yard. The Mandy through an open, transparent auction.
That was the noble theory. When it hit the dirt, the APMC morphed into one of the most extractive monopolies in the Indian economy.
Okay, how did that happen?
Well, because state laws forced farmers to sell only within their designated local mandi, it fragmented the country into thousands of isolated micro-markets.
So they couldn't shop around for a better price in another district.
Exactly. And within those mandis, the system was entirely captured by the commission agents known as the Arhatiyas.
Let's zoom in on that capture. How does an Arhatiya actually rig an open auction?
It happens through cartelization and interlocking markets.
Interlocking markets.
Yeah. The Arhatiya doesn't just act as a middleman for the sale, they also act as an informal moneylender to the farmer throughout the year.
Ah, I see where this is going.
Right. When the farmer arrives at the mandi, they are already deeply in debt to the specific agent running their auction. The agents collude. They decide the price beforehand over a cup of tea.
So there is no real bidding war.
None at all. And the farmer, who has no storage capacity and cannot afford to haul their rotting tomatoes back to the village, has to accept whatever depressed price the cartel offers.
The margins there are just sickening. The data shows that after the Arhatiyas take their cut and the produce moves through a multi-tiered chain of wholesalers and retailers, the farmer ends up realizing a pathetic 20 to 35 pays of every rupee the final consumer pays.
It's terrible. The majority of the value is vaporized in supply chain inefficiency and middleman extraction.
So how do we break this cartel?
The modern policy response is twofold: digital and structural. The digital silver bullet is supposed to be E&M.
The electronic national agriculture market.
Right, and the economic logic here is elegant. If you network all the APMC mandis onto a single electronic platform, you destroy the local monopoly.
Okay, walk me through how that works.
Sure. A trader sitting in an air-conditioned office in Gujarat can digitally bid on a lot of turmeric sitting in a mandi in Telangana. The local cartel's price fixing is bypassed by national price discovery.
It sounds like the perfect solution, but let me use an analogy here.
Go for it.
Imagine trying to buy a used car on eBay, but the listing has no photos, there's no standardized mechanics report, and there's no delivery service to bring the car to your house. Would you bid on it?
Never. Not a chance.
And that is exactly why E&AM is stalling, isn't it?
Precisely. You've hit on the physical constraint of a digital market. For a trader in Gujarat to bid blindly on turmeric in Telangana, they need absolute, unshakable trust in the quality of that crop.
Which requires standardized testing.
Exactly. But India severely lacks standardized assaying, grading, and sorting infrastructure at the mandi level. Without an objective quality certificate, the distant trader won't bid.
And I'm guessing the local Arhatiyas intentionally sabotage whatever grading process exists.
Oh, absolutely. Because the chaos protects their margins.
Right. So the digital market hits a physical wall. What about fixing the power imbalance directly? Instead of changing the market, change the farmer's leverage. I'm looking at FPOs, farmer-producer organizations.
Yes, this is the structural solution. The logic of an FPO is collective bargaining.
Okay.
If one marginal farmer with 1 hectare walks up to a giant food processing corporation like ITC or PepsiCo, they are a price taker. They have zero leverage.
Right.
But if you aggregate 1,000 smallholders into an FPO, suddenly you have the scale. You can bypass the mandi entirely, hire your own trucks, build your own cold storage, and negotiate massive forward contracts directly with the big buyers.
But the implementation reality
Requires monumental capacity building. You are asking a group of smallholder farmers to suddenly operate as the board of directors of a complex corporate entity.
That's a huge leap.
It is. They have to manage working capital, navigate GST compliance, and understand complex supply chain logistics. Without intense, sustained professional management and institutional handholding, many FPOs just collapse the moment their initial government grants run out.
It seems like all these market reforms keep crashing into the reality of physical infrastructure. If the FPO doesn't have a road or the Mandi doesn't have an assaying lab, the policy just fails.
Which is why we have to radically reframe how we view rural infrastructure schemes. Take PM-GSY, the Rural Road Scheme, or PM-Awaz Yashana for housing and Swachh Bharat for sanitation.
Okay.
In popular discourse, these are often bucketed as rural welfare or political handouts. In macroeconomic reality, they are pure productivity channels.
Expand on that. How does a toilet or a paved road show up in agricultural productivity data?
Let's look at the transit time. Post-harvest losses in India for perishables sit at a staggering 15 to 18%.
Wow, that much just rots.
Yeah. But when you pave a road under PM-KISAN connecting a remote village to a national highway, you drastically reduce the time it takes for a truck to move those tomatoes.
Less bruising, less rotting.
Exactly. And suddenly, the farmer can choose to bypass the exploitative local village trader and transport their goods directly to a larger regional market. That road is the physical transmission mechanism for market competition.
That made total sense. And what about housing and sanitation?
Well, housing and sanitation under PM-KISAN and Swafgarat directly slash the number of labor days lost to waterborne illnesses like cholera or dysentery.
Because a healthy farmer works more efficiently.
Exactly. Infrastructure is the bedrock that allows market reforms to function.
But even with a road and even with an FPO, markets fail. Prices crash. Monsoons fail.
They do.
And when that happens, the rural economy relies on the twin pillars of survival, credit and government safety nets. Let's tackle credit first.
Sure. The fundamental goal of agricultural credit policy for the last 50 years has been institutionalization. The state really wants to pull the farmer out from the shadow of the informal moneylender and get them into the regulated banking system.
And the mechanism for that is a vast network. You have NABARD refinancing commercial banks, regional rural banks, and cooperatives. And the flagship tool is the KISAN credit card, the KCC, which offers short-term crop loans at highly subsidized interest rates, effectively around 4% if you repay on time.
It is incredibly cheap capital. And to be fair, the policy has made huge strides. Informal credit dependency has dropped significantly over the decades to around 23.4% today.
But wait, that 23% represents the most vulnerable tier of the agrarian structure, right? The marginal farmers and the oral lessees we discussed earlier?
Exactly, because the formal banking system is obsessed with collateral. If you are farming on a handshake, the bank manager sees you as a systemic risk.
So you are shut out of the 4% formal loan and forced right back to the 48% informal money lender.
Yep.
And how on earth does a farmer service a 48% debt when the open market price of their crop suddenly drops by half at harvest time?
They don't. They literally can't. The debt spirals leading to asset liquidation or, tragically, much worse. And this catastrophic market failure is exactly why the state intervenes with the minimum support price.
Let's dive deep into MSP because this is an absolute minefield for the exam.
Oh, definitely. Pay attention to this part.
The concept is straightforward.
Yep.
The government promises to buy your crop at a pre-announced price, acting as a buyer of last resort to stabilize your income. But how is that price actually calculated? What is the math behind the politics here?
So the Commission for Agricultural Costs and Prices, the CACP, calculates the costs and makes recommendations. But the debate is a war over formulas, specifically the clash between the A2 plus FL cost and the C2 cost.
Okay, break those down for me. Start with A2.
Sure. A2 covers all actual out-of-pocket expenses incurred by the farmer. So buying seeds, fertilizers, pesticides, diesel for the tractor, and paying any hired labor.
Got it. And FL.
To that A2, you add FL, which is the imputed value of the unpaid labor provided by the farmer's family. The government's current policy is to set the MSP at a minimum of 1.5 times this A2 plus FL benchmark.
But if you listen to any farmers' union protests, they are violently rejecting A2 plus FL.
They are.
They demand the Swaminathan Committee recommendation, which is 1.5 times the C2 cost. So what does C2 add to the equation that makes it so contentious?
C2 is the comprehensive economic cost. It takes A2 plus FL and adds two massive imputed variables: the imputed rental value of the farmer's owned land and the imputed interest on the farmer's owned fixed capital, like their tractor.
Oh, wow. Let's think about the macroeconomic shockwaves of that. If the government capitulates tomorrow and suddenly mandates MSP at 1.5 times C2, they're suddenly paying farmers for the rent of land they already own.
Exactly.
That drastically inflates the procurement price of wheat and rice. What does that do to the fiscal deficit and retail food inflation overnight?
It would detonate both. I mean, the food subsidy bill would explode, massively widening the fiscal deficit, and the retail price of basic grains for the urban poor would skyrocket, triggering immense inflationary pressure.
So this is a tightrope the government is walking.
Very much so.
And the irony is, for all this fierce debate over the formula, the implementation reality of MSP is startlingly hollow for the vast majority of the country.
It's the 6% reality.
Right. The government announces MSP for 23 mandated crops, but physical procurement by the FCI is almost exclusively concentrated on wheat and rice.
And geographically bottlenecked, too, mostly in Punjab, Haryana, and parts of Madhya Pradesh.
So nationally, only about 6% of farmers actually manage to sell their produce at the guaranteed MSP.
Yep, the remaining 94% are entirely at the mercy of the open market, where prices frequently crash way below the MSP floor.
But even with that limited 6% coverage, India's MSP program is currently causing a massive geopolitical earthquake at the World Trade Organization.
Yes, and this is a critical area for your 2025 and 2026 exams. The WTO is aggressively challenging India's right to procure grain at these prices.
I've always found this fascinating. Why does a trade tribunal in Geneva care what the Indian government pays a farmer in Punjab for a sack of wheat?
Because the WTO's agreement on agriculture categorizes domestic subsidies into different boxes. Market price support programs like the MSP, where the government guarantees a price higher than the international market, are classified as amber box subsidies.
Amber bucks.
The WTO considers these highly trade distorting because they artificially incentivize overproduction, which can eventually dump cheap grain onto global markets and crush farmers in other countries.
So the WTO puts a leash on the amber box. Developing countries like India are subjected to a de minimis threshold,
Right.
meaning they are not allowed to provide amber box subsidies that exceed 10% of the total value of their agricultural production.
Correct. But here is the massive analytical aha moment you need for the exam. The conflict isn't just about the 10% limit.
What is it about?
It's about the absurd, archaic math the WTO forces India to use to calculate that subsidy.
Ah, yes. Walk us through the external reference price problem.
Okay, so under WTO rules drafted decades ago, you don't calculate your subsidy by comparing today's MSP against today's global market price.
That would make too much sense.
Right. You are forced to compare today's MSP against a fixed external reference price from a base period of 1986 to 1988.
Let me make sure I'm wrapping my head around this. It's like your bank evaluating your 2026 mortgage application, but instead of looking at your current salary, they calculate your affordability based on what your grandfather earned in 1986.
That is the exact perfect analogy. By completely ignoring nearly 40 years of massive global inflation, the WTO formula mathematically artificially inflates the size of India's subsidy.
Because the MSP in rupees today obviously looks astronomically higher than the global price of wheat in 1986.
Exactly. Because of this warped math, India constantly risks breaching that 10% de minimis threshold, severely constraining its sovereign policy space to feed its own poor and support its farmers.
So how are we getting away with it right now?
India survives right now using a temporary peace clause, but a permanent solution is totally deadlocked.
Wow. So the Indian farmer is squeezed by the local Mandi cartel, drowning in debt from the village moneylender, and their only state lifeline is being choked by 1980s accounting rules in Geneva.
It's bleak.
When the entire system fails, when the monsoon doesn't arrive and the crops die, what is the backstop of absolute last resort?
The Mahatma Gandhi National Rural Employment Guarantee Act, MGNRGA.
Let's dissect the textbook model here, because the economic logic is actually beautiful. It's not just a welfare handout. It's designed as a demand-driven, automatic macroeconomic stabilizer. It guarantees 100 days of unskilled wage employment to any rural household that demands it.
Right, let's unpack the mechanics of that automatic stabilizer function.
Please.
Unlike a traditional stimulus package where the government has to recognize a crisis, pass a bill in Parliament, and slowly disperse funds, MGNRGA reacts instantly to the labor market.
Because it's demand-driven.
Exactly. In a normal monsoon year, a farmer works their own field. Demand for MGNRGA drops naturally. But when a drought hits and agricultural employment instantly collapses, those farmers walk to the panchayat and demand work.
The scheme automatically absorbs the shock, surging funds precisely when and where they are needed most.
And the downstream effects are powerful. By injecting cash directly into the hands of the poorest, you create a massive multiplier effect on rural consumption.
Plus, it sets a floor for rural wages, right?
Yeah.
If the government guarantees 250 rupees a day, the local landlord can no longer force someone to work for 150.
Exactly. Plus, it builds rural assets like check dams and mandates strict social audits by the Gram Sabha to prevent corruption.
That is the pristine textbook theory. The reality on the ground, however, actively cannibalizes that macroeconomic potential.
It really does.
Because the entire efficacy of an emergency safety net hinges on speed. MGNRGA has a statutory 15-day payment rule. If you do the physical labor, The state must put the cash in your bank account within 2 weeks.
Because if you are starving due to a crop failure, you cannot wait for the bureaucracy to catch up.
But what does the data actually show?
It shows chronic, systemic delays. Fund flows from the central government to the states are frequently choked. In many states, payment delays of 60 to 90 days are the norm, not the exception.
And think about the chain reaction of a 90-day delay. If a laborer knows they won't get paid for 3 months, they lose faith in the scheme.
They might opt to migrate to a city slum instead of waiting for a ghost paycheck.
Which completely defeats the purpose of emergency income support. Add to that the frequent shortages of materials for the actual work sites, and the reality of MGN Regie is struggling to fulfill the immense promise of its design.
Which brings us perfectly to the exam horizon. We've mapped the entire life cycle today.
We have.
From the structural traps of fragmented land, through the ecological toll of the Green Revolution, past the friction of APMC Mandis, right into the complex web of credit, MSP, and MGN Regie.
So, based on the macroeconomic climate and recent question trends, let's strategize directly for what our listeners are going to face in the IES 2026 GE-04 paper.
Yes. Here are the 3 most critical thematic areas you must be prepared to dissect.
Right. Notebooks out. What is prediction number 1?
Number 1 is the inescapable tension around the minimum support price. Do not just write a generic essay on farmer welfare.
What should they do instead?
You need to contrast the economic rationale of price stabilization against its spatial failure, the 6% reality. But the differentiator for top marks will be your analysis of the WTO.
Ah, the external reference price math.
Yes. You must clearly explain the math of the 1986-88 external reference price and articulate the fierce tension between India's amber box constraints and the non-trade distorting green box alternatives.
Excellent. Prediction number 2.
MGN Regie as an automatic stabilizer. The examiners are tired of reading basic summaries of the act.
Right, they know what it is.
You need to focus on its macroeconomic function, how it sets a floor for rural wages and drives the consumption multiplier. And crucially, you must diagnose the implementation failure, how the 60 to 90-day delayed wage reality structurally destroys its capability to act as an emergency shock absorber.
Very clear. And the final prediction.
Agricultural marketing reforms. Frame the legacy APMC acts not just as markets, but as interlocking cartel monopolies.
Yaratias.
Exactly. Use that as the setup to evaluate E&M and FPOs. Don't just praise the digital or collective solutions. Rigorously explain the physical and institutional friction.
Like the lack of grading infrastructure for E&M and the need for capacity building for FPOs.
Precisely. That friction is what slows their adoption down.
We have covered an immense amount of ground today. We started by dismantling the assumption that the large farms are always better, diving into the inverse farm-size productivity relationship.
We covered a lot, yeah.
We traced how the failure of land reforms and the rise of oral leases pushed farmers into the arms of the 48% moneylender. We celebrated the caloric triumph of the Green Revolution while mourning the plunging water tables of Punjab.
A heavy price to pay.
We walked a tomato through the rigged auctions of the Mandi, tested the limits of E&M's digital reach, and unraveled the absurd 1980s math constraining India at the WTO. Finally, we looked at how delayed paychecks break the promise of MGN Regie. We truly wish you the absolute best on your GE-04 revision.
Before we sign off, I want to leave you with one final provocative thought.
Okay, let's hear it.
We discussed the intense pressure from the WTO regarding India's amber box subsidies and how India might eventually be forced to adapt. This raises an incredibly dangerous question.
Okay.
Imagine if India decides to satisfy the WTO by entirely dismantling its physical MSP procurement. They shift everything from the trade-distorting amber box to the permissible green box by simply giving farmers direct cash transfers, an expanded PM-KISAN, for example.
I mean, on a spreadsheet, that solves the WTO problem overnight.
It does. But what happens to the physical grain? If the FCI stops procuring, they stop stockpiling. Do we risk dismantling the massive physical buffer stock infrastructure, the go-downs, the logistics network that literally guarantees our national food security?
Oh, wow.
A cash transfer in a farmer's bank account is highly efficient, but you cannot physically eat a digital bank balance during a severe famine. It is a profound, terrifying tension between global trade compliance and domestic survival.
That is something to think about. So as you head into the exam hall, remember the broken precision machine we talked about at the beginning. When you write your answers, don't just regurgitate the textbook theory. Look for the friction. Look for the muddy water. Because in Indian agriculture, the truth of the policy is never in the design. It is always in the execution. Good luck.